Time for Ask Annex. Got a question? You head to our website, annexwealth.com. Look for the Ask button. Fred Coleman, CFP and Wealth Manager, is here. Hey, Fred.
Hey, Danny.
Matt Morzy is Director of Research at Annex Wealth Management Investment Committee and a CFP. Welcome back.
Hey, Danny.
All right, question number one. When I look at my 401k returns, I see 12-month, year-to-date, 3-month, and 6-month numbers. Which matters? I'm long-term, so I believe 12-month is the most important.
Yeah, it's a good question and one that comes up quite frequently. And a couple of things that I'd want to know before really be able to have that conversation with the person is, what are you trying to figure out and why? Are you trying to figure out how the different funds that are in your portfolio or that are available to you are doing versus their benchmarks? Are you looking to see how well you're doing versus, how you think you should be doing? I'd be looking at those types of things. When we generally talk to people about the returns with their 401k, a lot of times the part of that answer ends up being, how much risk are you taking? And then again, what are you comparing it to? Because everything in investments is relative. So if you think your return should have been higher, but you're 60% stocks and 40% bonds, maybe you're not taking enough risk and the market had gone up and you're trying to chase the S&P or you're trying to chase something like NASDAQ that has gone up even more. So how much risk are you taking in there? And then within each of those areas too, how well diversified are you and how much risk are you taking? You might be at the right level of equities, but if it's all large cap growth, which has done really well in 2023 and, parts of 2024, that's great. But were you okay to weather that in 2022 where large cap growth led the market down? And how comfortable were you there? That's usually what it comes down to when I jump into a meeting with some of our clients and we're talking about their 401k returns. It turns out that they're either trying to chase the market and they're trying to understand how much risk they're taking there. So that's what I would be looking at. But also, just to kind of throw this out there, 12 months is not long term. 12 months is actually really short term when it comes to investing. Long term is 10 years, 20 years, 30 years. You think somebody starts investing in hopefully their early 20s, they might be investing for 60, 70 years. A 1-year return, although it seems important to us now, looking back, is not generally that meaningful.
Next up on Ask Annex, please explain how a mega backdoor Roth works, besides having an awesome name. That's pretty cool.
That is a really great name, and I think the name gives it even a little bit more intrigue to make you want to do it. So a mega backdoor Roth, I know it says Roth, but it's within a 401k. So your 401k plan does have to offer the option to do what's called voluntary after-tax contributions. So the IRS gives you employee limit that you can contribute. Usually with the catch-up, it's around $30,000. Then you have employer matches. But in addition to that, some 401k plans have what's called voluntary after-tax contributions, where you can make after-tax contributions out of your paycheck, and that goes into a separate bucket. Now, where the mega backdoor Roth comes into play is not only can you make those contributions, but you have the ability to roll that money out of the 401k plan into a Roth IRA. Now, it's really important that you do it correctly because there are tax consequences if you do it incorrectly. But if you do execute it correctly, it could be really beneficial.
Ask Annex. Got a question? You head to the website, annexwealth.com. Look for the Ask tab. If we can help, you click that Get Started button. Next up, CBS News had a story where it was suggested savers put cash into either CDs, high-yield savings accounts, money markets, or treasury bills. One of your radio people mentioned commercial paper. What is that?
Generally can be short-term unsecured debt. Think of it as companies who are trying to match up short-term cash needs. But there's not necessarily an instrument for them to go and use because people are generally not going to want, a 1, 2, or 3 year corporate bond that's going to be brand new. A lot of those are usually a little bit longer in terms of their maturity. So commercial paper is going to be really short, unsecured. It's going to go to cover things like payroll, inventory, stuff like that. Does not have, direct claims to anything in particular. It's another way for usually financial institutions, money markets, stuff like that, to be able to get a higher yield. You're taking a little bit more risk on it, but obviously you're going to do the due diligence on whether or not, they're going to make their payroll, that they're still going to be in business and be able to pay that back. But it's a little bit more, just a step out from a risk curve on some of those other things that were mentioned.
I think that's the a big point because when you compare it to CDs, high yield savings accounts, money market, and treasury bills, those are risk-free assets, where commercial paper, it can be, lower risk, but it does carry some risk with it.
Do you find that people understand stocks more than like fixed income?
Yeah, because stocks is what's flashy.
Right.
That's what's talked about all the time. But fixed income is a vital part of the portfolio also.
Yeah, I would agree. I mean, stocks are really straightforward. It's part ownership of a company. And so you're going to make or lose money based on the health of that company and the perceived value of that company over time. There's a lot of different asset classes within fixed income that most of the time do not get talked about very often. But that's really kind of like the oil that helps lubricate the financial machine is all the fixed income and the different, sources of debt.
Yeah, but that's a whole lot of math.
Yeah, our Todd Voigt usually says bonds are about 2/3 math in terms of what the return is going to be. They're very predictable.
Okay, Fred Coleman, CFP Wealth Manager, thanks.
Thanks, Danny.
Matt Morzy, Director of Research, Annex Wealth Management, thank you.
Thank you.